Hello, everyone. I'm Jesse Pound. I'm a reporter with CNBC.com and CNBC Pro. And this is the view from the exchanges. What we're going to do here today is get a little bit of perspective from these pros on how the exchanges are looking at this sort of constant change in the ETF industry. Um, and, you know, it's good sometimes when you're too focused on your individual product lineup or your services to get more of a macro view to start off. And that's what I'm hoping to help with here today. So I'm joined by Victor Werney, head of North American ETP listings at SIBO, Tim Riley, head of exchange traded solutions at the NYSE, and Danielle Rutsky, the head of NASDAQ ETF listings. All right. So to start with, since we last had an ETP forum late last year, we've had a few major volatility events. So it's always good to sort of check in and see if anything broke. We learned anything new during those events, including the early April volatility around the tariff rollout. So Danielle, let's start with you. What have you learned on the exchange side in the past 6 months?
Yeah, so as I think many of us know at this point, there have been a few tests, COVID, now, tariff volatility that have tested these ETFs and really confirmed that they are price discovery vehicles and vehicles that traders turn to in times of volatility. So we saw ETF trading increase during that week of April 7th during the tariff volatility, which was expected. We saw more volume come on exchange. Around 60% of ETF trading was on exchange compared to around 55% where it normally is. And we saw the average ETF double in terms of its average daily volume compared to looking at the entire year of 2024. So that's a lot of trading going on in ETFs. And what people often ask is, can the ETF vehicle handle all of that trading? What will happen to its primary market? And we actually saw that the ratio of primary market creations or redemptions that happen, the changes in shares outstanding that you see in ETFs, was actually quite consistent or decreased during the week of April 7th compared to, throughout 2024. If you look at it, 13% of secondary market trading results in primary market trading. During the week of April 7th, it was actually only 8% across all ETFs. For lower liquidity types of underlying asset classes, such as something like ETFs focusing on loans, it's normally around 20% of secondary volume, and it was actually consistent the week of April 7th as well, with 20% of secondary market trading resulting in primary creations or redemptions. So ETFs held up well again, another testament to their resiliency as a vehicle and a tool of choice for investors and advisors.
I would just add that the overall market, the U.S. marketplace, the exchange ecosystem, held up tremendously well. Prior to late winter and spring of 2025, the record average daily volume in U.S. equity markets was around 24 billion shares. We crowded up to 30 billion shares a day in the events and the weeks in the first quarter and the early part of the second quarter. We always like to kind of look at other regions around the world, and we were getting calls on a specific Monday about Taiwan Semiconductor. You couldn't sell the stock in Taiwan, yet you could sell the ADR on U.S. markets. And it was because of halts and concentration and some other kind of rules specific to the Taiwan market. But data management, data throughput, clearing and settling, the U.S. framework held up. And I compliment my peers up here and the industry for investing, for testing, for building out that resiliency to handle the appetites, interests, and investments of global participants. So it's something that we can't be proud of too much because we'll get killed. Like, we'll blow up this afternoon and you'll all hate me. But I do think it was an example of long-term investment, dedication, the discipline, and really the boring stuff that exchanges, investors, and regulators do in order to create the single greatest capital market system in the world. So I think that that's really an important thing outside of the ETF world to be aware of. I will say, just specific to ETFs and the volatility, the velocity of creation and new products over the last couple of years has strongly indicated that there's an ETF for every strategy, an ETF for every thought, an ETF for every asset class, and so the volatility that turned up wasn't only about kind of what a new active fixed income fund was trading in that volatility. A lot of it was concentrated in hedging instruments, and the elegance and the specifics of how a product is products, single stocks, different option structures, different kind of short and long relative products were really suitable to the volatility in the market in the first and second quarter. And again, that's a comment back to the issuers in the room for innovation and discipline and bringing products to the market that fit the time. So it wasn't really just only about, hey, I have a healthcare ETF, it's awesome. It was, I have a double short ETF on the S&P that I can utilize this tool to hedge my portfolio in volatile times. So I think one of the things that really demonstrated to us at the New York Stock Exchange was the amount of innovation and creativity in the ETF marketplace. And as we all know, more to come.
Yeah, just to build on that and round it out, on the SIBO side, when we look at product inflows and net flows, for defined outcome ETF specifically in the week following Liberation Day, we observed roughly $600 million in net flows into defined outcome ETFs, which is an 800% increase over the prior week before Liberation Day. So to Tim's point, we were seeing a wide variety of people go into hedging strategies, products that are incorporating options-based elements, and further diversifying the products that they're holding. But looking at market structure overall on the ETF side, I think my peers here did a great job of outlining that everything happened as it should. Limit up, limit down bands worked great. And a lot of the testing that we did to prepare for this volatility and the volatility that we saw over COVID really prepared us for Liberation Day and Liberation Week.
Tim, I want to go back to what you said about all the new issuances and different types of funds that we're having. So last year we had more than 750 launches, according to Morningstar, based on the amount of pitches that hit my inbox every week. I say we got a shot to break that again this year. And a lot of those are active products or products that are counted as active, but are really some sort of defined outcome product or a hedging product. And so, Tim, could you talk a little bit about how those types of products, do they need anything different on the servicing side from the exchange? And maybe how do you and the issuer work together to position any of these new funds for success in such a crowded marketplace?
Well, let me dial you back a little bit first, because the question is in the context of, well, we had this historic sell-off, or what it felt like a historic sell-off prior to the rally back. And those of us that are old like me have this kind of respect that, well, when markets are down, markets are volatile, IPOs don't happen. The capital markets shut down. That's kind of like the belief. You talk to ECM desks and such. We're pretty good at bringing stocks public at the New York Stock Exchange, and we had kind of high profile names like StubHub that were supposed to go public in April, just put their pencils down and say, we'll see you in a few months. And only really in the last couple of weeks have we seen a few IPOs successfully come back to the marketplace, which is awesome. But equity capital markets is what I just described about corporates. In the ETF world, the velocity of new issuance in February, March, and at least the first half of April was extraordinary. And it goes back to my comment earlier that, when some folks think about products, they run to VU or SPY or IVV or, some of the kind of the old guard of kind of long only one-way products. And again, the innovation that allows for the velocity of new products to come out to solve all kinds of different strategies, all kinds of different exposures, did not go away because the market was volatile. In fact, actually, as Victor, your example, there was actually a larger appetite for them. And the other thing that, we're business people in this room. It's one thing when a corporate, if StubHub doesn't go public, you can still go on your phone and buy some Yankee tickets for the game tonight. If a municipal bond ETF that's been kind of 18 months in the prep section and the making has a date to go public, it is very to go public as an ETF. It's very difficult to roll that back from a business and say, oh, we're going to wait another year. So the dynamics of kind of an operating company versus an ETF and delaying, postponing, changing your trajectory to markets is a pretty substantial one. So despite market conditions, innovation, schedules, investor appetites, all led to a really, really strong issuance calendar, which continues really up to this point.
Yeah, to kind of build on that, Jesse, and the types of products we're seeing come to market in this environment, we're really seeing a rise in issuers launching products based on single stocks, whether they're leverage and inverse, different covered call strategies. We're seeing a rise in active-based ETFs overall. Looking at year-to-date statistics, roughly 85% of all ETFs that have come to market are actively managed products. Furthermore, 40% of those products are some sort of derivative-based product, whether they're holding futures, swaps, options, whatever it may be. On the SIBO side, going back to the exchanges and how they're working with issuers to help bring these products to market, for options-based products specifically, we have tremendous flex options expertise internally at SIBO that really partners with a lot of different issuers on the products they're bringing to market. Furthermore, we're able to support INAV calculations, theoretical option pricing, pretty much the whole ecosystem for options-based products. And to Tim's point and Danielle's point earlier, when we're looking at the growth of the ETF ecosystem in these times of volatility, we're really observing more and more issuers dip into options to differentiate their existing product offering today. But with that said, we absolutely touch all different types of ETFs. Not only are we seeing options and leverage and inverse ETFs, but we're also seeing issuers bring together new equity strategies, different variations of fixed income, and other types of unique bespoke strategies in the ETF wrapper today.
Yeah, to that point, the landscape of ETFs has certainly grown with record launches for the past 3 years, surpassing its own record. And on top of that, AUM has grown. We're at $11 trillion in assets under management for the ETF space. So there are assets to go around, and people often ask, how do I have a successful ETF launch? How do I grab a piece of those assets? Because there are a lot of different brands and different companies that are now looking to the exchanges to launch their ETFs. So it's not just large asset managers or banks launching these ETFs anymore. There's over 360 different brands on these different ETFs and different target markets that these brands have and relationships. And that doubled since 2020. So there's a lot more competition out there in the market. And what's really important is that these new issuers that are coming to market with these active strategies might have had this in a different wrapper before. So they have a client base that they are looking to attract and looking to grow. So when the exchanges can help these issuers with getting their name out there through marketing and speaking opportunities and brand opportunities and amplification, those are the types of things where we can be really helpful to capitalize on our $13 billion brand to really bring the issuers a piece of that pie.
A good panel should also talk about things that are negative. One of the downsides that's kind of occurred is some of these active funds, some of these long-only funds that did launch in that period, they got absolutely hammered. And we had some tough calls with folks about that experience if they came in February or March prior to the rally, about timing, performance, measurement, all these kind of things that are really challenging. So while we are speaking about like sunshine and rainbows and the ETF business growing hand over fist, there were difficult days with issuers and with investors. Even some of the creative products, double long a Mag 7 versus shorting an OG S&P 500 type stock. Some of those strategies got hammered in the Mag 7 sell-off. So the new products that came out and the solutions that have come to the market are truly innovative, but it all hasn't been sunshine. And it's been really, really difficult for some of those long-only or active managers that did issue in February, March, and early April. Really until the last few weeks. So there's a lot of good things, but it's been difficult some days.
Great. Yeah. Got to take both sides of the coin into account. Victor, I want to circle back to something you said about all these different derivatives products. I feel like last year the two big trends were derivatives-based products, and from a flows perspective, for sure, the crypto funds, the Bitcoin funds in particular. And it seems like this year one of the big trends is going to be bringing those two together. Can you, briefly hit on, from the exchange's point of view, are there any complications, with that sort of marriage of those two styles, and or what concerns come from the fact that the options markets for the Bitcoin funds that are already out there just aren't that old, and maybe aren't as liquid as a SPY options market?
Yeah, thanks, Jesse. So we're always constantly speaking to our issuers about what does your product 2.0 look like. On the US side, we launched the majority of the spot Bitcoin and spot Ethereum ETFs on behalf of the asset managers that we partner with. And when speaking to them, we're really wondering, where do we go from here? Is it a different coin? Is it an options-based product? And from speaking to a lot of these different asset managers, it seemed like there was a very large interest to have an options-based product on a spot digital asset. So from there, we worked with a few different teams internally on the SIBO side and came up with the idea of an index options contract with an index that holds spot Bitcoin ETFs, CBTX and MBTX. With this, it gave issuers the ability to utilize flex options on that index that was holding spot Bitcoin ETFs and create defined outcome ETFs, covered call ETFs, utilizing this index for their ETF creation. So we're constantly partnering with not only our issuers, but our derivative colleagues on bringing forward solutions to market that benefit the whole asset management community and industry as a whole. So with that, there's a number of different defined outcome ETFs out there today utilizing different sorts of Bitcoin contracts or whatever it may be. But we're kind of really excited to see what that next phase of growth is and how issuers are going to continue to innovate in the option space as digital assets grow.
Tim, did you want to add something?
I would just add that, and you make a good point on the elasticity of kind of navigating very specific position limits and limitations that are very tied to the digital asset space from a regulatory point of view. So flex options and other solutions, and really working closely with the OCC in dialogue about how things are calculated, have become really kind of core to how we operate and how we serve those issuers in order to get their innovative markets and the products to market in the digital asset space and the linked option space, and certainly in how you can tie that all up in a package. I think we have a question coming up later about the regulatory environment. We're also dealing with a regulatory environment that's changed radically in the last 3 months, and so it's allowing for more creativity, and then exchanges that are committed to things like flex options and other solutions that kind of expand the playing field for the digital asset space are kind of core to being able to kind of serve those needs. But a lot's changing rapidly, and I think all the exchanges, including ourselves, are deeply engaged with issuers and also regulators.
Yeah, because it's great that these other solutions exist, but there's a lot of different flavors of crypto ETFs now, and issuers want to be able to kind of take their cryptocurrency exposure and receive it in different ways, whether that's hedged or income or asset allocation. But you're still seeing 91% of the $16 billion in inflows year to date be in those concentrated spot Bitcoin type of ETFs. So there's definitely room for kind of those avenues into the other types of ETFs to be opened up, so issuers and investors can execute on what they want.
Great. Well, Tim, you brought it up, so let's dive into the regulatory aspect of things. I think it's fair to say in the first 4 months or so of the Trump administration that this is going to be a lighter touch regulatory regime, but when you dive into the details, there's upsides and downsides to that for really all the industry participants. So, Tim, could you talk a little bit about how your communication with the SEC has changed in the last 6 months, and sort of what your major takeaways are so far?
So I'm going to defer on commenting anything on President Trump specifically. I like peace and harmony in a room, so I'm not going to go there. But certainly we are an organization through trading, capital markets, data, et cetera, that work very closely with the SEC and all regulators. But I'll keep my comments to the SEC. Despite friction and frustration with the Gensler regime, we certainly had a lot of dialogue with them. We had it was rather formal in nature. But there was back and forth. We disagree with them on many aspects of micromanagement of markets and overregulation, and kind of putting barriers to on issuers to getting to kind of public markets, as we're a strong believer in more companies, more ETFs, more products should be available to all investors through the beauty of the exchange listed product and the accessibility that offers. So while we might have had frustration with the policy of some of the old SEC, at least they were staffed, at least there was formal communication, at least there was a framework. What we're finding in the new regime is Atkins doesn't even have a staff yet. Atkins is actually using leaders or partners from other cabinet members to kind of run his operation, even though it took a while for him to get through the process, not because of any controversy around Commissioner Atkins, but more just because of kind of the throughput of Senate, et cetera. We're finding an SEC that is much closer to yes than no on so many different questions. There is kind of an awareness that they're pushing out the kind of accountability and responsibility for surveillance more on the exchanges, the issuers, and other organizations, and away from themselves. And that certainly is helpful in velocity to market and innovation. But we should be vigilant on surveillance. It is our responsibility as industry leaders, as exchanges, to be responsible and stewards of what's available to investors and what can come to market, and to protect those investors. And the SEC has that responsibility as well. So we're enjoying the elasticity and the cooperation of an SEC, but we have due concerns that the reason that it's like that is they're notably understaffed, as there's a lot of people that have retired that had a lot of experience. Again, we didn't always agree with those people that had a lot of experience, but their experience was valuable in the process. And then just to kind of a culture down there that is quicker to yes. We like quicker to yes, but we like yes with vigilance.
Absolutely. And with any changing of the guards, any change in the political administration, it is an opportunity to raise these questions and kind of voice our opinions as market participants. So NASDAQ did write a paper about ways that we feel the U.S. public economies can be advanced, and topics that this commission we feel should be looking at. And we also was able to meet with the crypto SEC task force and wrote 2 crypto comment letters. So this is definitely the time to start engaging with the SEC, as we do when there's any types of new product launches and new asset classes, to decide how these should be handled, especially as ETF issuers want to put more of these digital assets into their market. We need definitely to know how to classify these.
Yeah, I just close it out with, on the SIBO side, we have a plethora of filings out in front of trading and markets today, and there's been pretty good active dialogue in a wide variety of different areas. So we're excited to see this new regime and how it plays out in the ETF ecosystem today.
Great. Let's get a little bit more in the weeds and focus on share class relief. As most of you, I'm sure, know already, it's over 50 or almost 60 now. Asset managers have filed for the ability to list an ETF share class and a mutual fund share class under the same umbrella. Based on the pattern of some amendments, it seems likely that we might get some sort of at least preliminary SEC ruling on that fairly soon. And then the hard work begins on figuring out, from a technical aspect, from a marketing aspect, how to actually make that a reality. And so, Danielle, I was hoping you could start and tell us a little bit about, from the exchange's point of view, what are some of the complications or concerns that come to mind when you look at the possibility of having this flood of new ETF share classes hitting the market?
Yeah, so we definitely wanted to make sure that from a exchange, onboarding, listing rules standpoint, that we were as prepared as possible. So at this point, all of our exchanges have filed for generic listing standards, so that way issuers could feel comfortable that we will be prepared to quickly bring these to market once these generic listing rules are approved by the SEC, and also that this type of product is approved by the SEC. So we're still waiting on approval from both of those standpoints, obviously, but if the SEC does approve this multi-share class structure for ETFs, there wouldn't have to be an onerous process of writing a 19B4 for each of these ETFs and different kind of standards than what ETF issuers are used to today in terms of what they provide on their websites for 611 requirements. So, we've pretty much standardized that to, what people are used to for NAVs, 30-day median best spreads, things like that, daily transparency. So it's really going to be a topic of, to your point, are the issuers, prepared? It is a lot of work, and I don't, envy those that have to kind of figure out how to really conjoin, the transfer agents, the custodians that need to be a part of this process in order to make it seamless for the end investor, and all the monitoring that will need to happen to ensure that there is kind of no beneficial treatment of one share class versus another if there are capital gains from trading, and all the reporting that will need to go to the board. So it's definitely going to be a lot of work if this is approved. So it could be a few months to maybe a year, maybe more, once the actual first product utilizing this structure comes to market. But a lot of that is to be seen based on what the SEC says when they approve this too. There's definitely some clarity that the industry is still looking for on this topic.
Yeah, happy to jump in there. So really multi-share class as a whole is a super exciting topic. If 10% of mutual funds add a share class, that's roughly 1,000 new ETFs that can come to market. So we've had a filing in front of Trading and Markets for just over a year now, and we've had a few different iterations of it. And essentially what this filing with Trading and Markets is designed to do is we can all list multi-share class ETFs today if we absolutely had to. The issue with listing multi-share class ETFs today is that we would list them under a rule set that's prior to Rule 6c11. And that rule set, it's antiquated. For those in the room from a product and capital markets perspective, you may remember we were making exchange rule filings for fixed income and options-based ETFs before Rule 6c11. So we definitely don't want to go back there if we can avoid it. So what our filing with Trading and Markets is essentially saying is as long as the issuer gets approval from investment management on their exemptive relief, we can essentially list that ETF in a very similar manner as to how we would list our 6c11 ETF today. So we're constantly working with Trading and Markets, our regulators, to really see how we can streamline all these ETFs coming to market. But when speaking to our clients and our other industry partners, one of the main concerns that we're looking to address is really market maker support. With the market makers out there today, there's about 11 or 12 lead market makers that have supported the ETF industry since the past 10 years, pretty much. So what can we do to further market maker support? How can we advance market maker support? How can we partner with our colleagues and partners to further that so that when issuers are ready to come to market and hopefully multi-share class does get approved, the industry and the exchanges specifically are ready to support that?
It comes up in almost every client meeting we have. And so what do you think on this? It's rather barbelled. There are some platforms that say this is going to be terrific. This is going to be wonderful for our franchise. It's going to extend our reach, our capital raising opportunities, and our brand. Others say this is going to make the industry more crowded. It's tough enough to get our messages out. We have extraordinary partnerships with media and marketing resources. And what is the cap on how many times you can do interviews and campaigns and billboards and all the other things we do to support our issuers. So there's a kind of velocity capacity issue, but the velocity issue is really important. And Victor, you just referred to it. Just because it's approved, so the dimensional filing goes through. I doubt there's a lot of people in this room that think that the velocity of issuance between, say, September 1st and February 1st is going to be extraordinary, because the various working groups in the industry, the clearing, the brokers, the kind of ecosystem and infrastructure around this has to be built in a much more tactical and scalable way, and somebody's going to have to pay for that. From what I think we hear in our seats, that question is yet to be solved. So the velocity of upon the approval of the multi-share class framework, the velocity of issuance may be more of a 2026-27 story than a 2025 story. And I just want to reiterate Victor's point on market making capacity. It's one of those things that doesn't feel like a problem until it's a problem. And if multi-share class is number one that comes up, second is marketing, media, and asset gathering support for our issuers, which is a really important topic, and we're really good at it. But the third piece that comes up is market making and the lead market maker spot. And when you get away from the largest issuers that have all kinds of different ways to kind of work with market makers from a commercial point of view, it's starting to get a little tight. And if we see 1,000 new issues in a 7 or 8 month period, it's going to get really tight.
And that's why I mentioned the doubling of the brands, because to your point, it already has. And it's something that I think comes up in almost every conversation as well. And, what happens if I do have bad market quality? Well, it does make it harder to sell the ETF. So it's important. And I think another question that we probably all could attest that we hear all the time is, well, how often are delistings happening? How many ETFs delist every year? And how can I ensure that that doesn't happen for my ETF? And I think if all of these ETFs come to market, that's natural. That's competition. Delistings there's about 6 for every one in 2021, and then it kind of went down to 3. And last year we were around 2 delistings for every 1 ETF. So that's pretty low historically. And so far this year, it's always higher at the beginning of the year, so it evens out. So it's not totally accurate, but it has increased so far this year to date, because there have been a lot more ETF launches. So it is the natural progression of things. If you can't amount to a certain amount of assets after a few years, if you can't find the right market quality, these will be things that set issuers apart from each other and the ETFs that stay listed versus delisted.
And even to put a point on that too, like as an industry, we're on pace for over 1,000 ETF launches this year, multi-share class aside. So really, people are rolling out ETFs in all different flavors and varieties. And to build on something Tim said a little bit earlier, is really not every fund structure is actually meant for an ETF. Just because you're able to launch it in an ETF wrapper, it doesn't mean the ETF is the right vehicle for that fund structure. Maybe a mutual fund or SMA strategy is the right wrapper. So I would just caution that just because it fits in an ETF doesn't mean the ETF is the right vehicle to advance that investment strategy.
Great. And yeah, just to sort of add to the timeline idea, when I spoke to Gerard O'Reilly from Dimensional a couple months ago, he said that they were looking at 6 to 9 months post approval for the first share classes was sort of what they were working on. So that would push it into 2026 at the very least. Right. Another sort of regulatory trend that we're seeing on the exchange side is the expansion of trading hours, or the push toward 24-hour trading or 23/5, however you want to characterize it. And that personally stresses me out because I really like being able to shut my computer at 6 p.m. But Victor, I was hoping you could speak a little bit about from an ETF issuer and service provider point of view, is this something that they need to worry about in the near term in terms of staffing and making sure technologically that's possible? And if it is, how do they make sure that they're included in sometimes limited number of issuances that do trade in extended trading?
Yeah, so 24/5 trading is a hot topic for all of us on this panel. On the SIBO side, what many people don't realize is our options and futures market operate 24/5 today. And across North America, we're set up for 24/5 operational coverage for all of our markets, whether it's equities, futures, or options. Being that we're a global firm, we have trade desks across the globe. So we have a trade desk here in the United States, a trade desk out in Australia, and a trade desk over in Europe to satisfy that kind of follow the sun movement for trading hours. But bringing it back to ETFs, the biggest kind of comment we get when speaking to capital markets teams is the fact that pre and post markets are unprotected markets. And during core trading hours, you have limit up, limit down bands for investor protection, and you don't necessarily have those in the pre and post market hours. So as an industry kind of working towards what can we do to advance investor protection has been top of mind, I'd say, for pretty much all of us on this panel and our clients. 24/5 trading is really interesting in the sense that a lot of that demand is coming from the Asia Pacific region. A lot of people in Asia are accessing US equities for a wide variety of reasons. We expect that trend to continue. Statistically, in 2024, we are seeing roughly 40 million shares on average traded in our pre and post market sessions. This year, year to date, we're averaging roughly 90 million shares plus. So we're definitely seeing a big tick up, and it's a trend we don't see disappearing anytime soon. But we're looking forward to continuing to work with the rest of the industry on advancing this initiative and coming to a consensus on different things like corporate actions, when we're turning off our exchanges, or limit up, limit down bands, so that we're really advancing investor protection as a whole as an industry, because at the end of the day, that's what we're all here to do.
As far as kind of 24/5 or 23/5 is kind of how, there's a couple things I would just point out. You can trade an ETF on any of our markets from 4 a.m. To 8 p.m. already. Like those, they're open. There's quotes. I'm not going to comment on market quality, but the pre-open is we've done a lot of analytics on it. NYSE ARCA is the number one exchange for off-hours trading, has been for a decade. The pre-open session at 4 a.m. to really 9-ish is very retail orientated. We're not going to get into specifics, but Asia is pretty active at that point, and have really been driving demand for early morning or earlier morning trading. What's interesting is after 4 p.m. Eastern time, in general, that is a more institutional. That 4 to 6 p.m. is much more institutional in nature. Larger prints, if you're an exchange, you have some insight into which brokers are active in those periods. So it's sort of interesting as far as who is more active in segments of extended hours trading. Consensus now is kind of come that we're going to close from 8 to 9 p.m. Everything before 8 a.m. will be trade date. Everything after 9 p.m. when the markets reopen would be the following trade date, and that begins to address some of the issues with DTCC and clearing the settlement. So the infrastructure and the mechanics, not inconsistent with what we were saying earlier about multi-share class, have to catch up with kind of global investor demand to access U.S. markets. But for those that are worried or concerned that they're going to suddenly have to be, or at least in the near term, looking at 23-hour staffing, et cetera, if you're not staffing from 4 a.m. to 8 p.m. now in order to markets, the market being active longer than that is probably not going to change much of your staffing. Second is things like the closing auction, very near and dear to Danielle and I's operations. NAV calculations, corporate metrics, index reference prices, options reference prices are very, very tied to that 4 p.m. Eastern time close every day. Corporates do not want that to change, and that is important. So all the work to kind of work to serve a global marketplace and other regions of the United States beyond the East Coast. If you're a dentist in Denver and you want to buy Spotify at 3 o'clock in the afternoon local time, maybe you should be able to. You could now, but maybe you should be able to in a more quality market. But the 4 p.m. close on the East Coast will continue to be a very protected, pivotal, influential, and essential part of how so many of your operations work today. So don't get out there hiring people 23 hours a day yet. But you're as Dan Ives was saying earlier, you might need some AI extensions to kind of surveil some of that in the middle of the night.
And to Tim's point, the closing auction will still set official closing prices in these case scenarios, as will last sale eligible trades continue to set what is the high and the low price in the last sale for intraday trading for core hours being 9:30 a.m. to 4 p.m. So there are some industry consensus around certain topics. The things that we all need to continue to work on as an industry and figure out. We're the SIP operating 24 toward 23.5, and when will those breaks be? And the corporate actions, when will they be treated for the next day? And Tim was mentioning how well the exchanges function during the volatility. That's because we test before we make these updates and releases. And so when will those updates and testing happen if the market is always open? So those are things that we'll think through, as well as the trade reporting facility. NASDAQ runs the largest trade reporting facility, or TRF, where trades that happen after core hours are then reported to the tape. And so, a lot of details will still need to be worked through before 23.5 is officially happening. But, I echo the other panelists in terms of what the ETF issuers, are really focusing on and would be, your shared concerns are, what will those protections look like after hours? How will the order protection rule be handled, limit up, limit down bans? So I would definitely, advise staying in the loop as to, how that will all be handled as this shakes out.
Great. Well, we've got about 10 minutes left, so I'm sure you're all tired of hearing me ask questions. I'll open it up to the room. If you can ask it to an individual panelist or throw it to the panel as a whole.
Thanks so far. I'm on the product development side of the coin, so it's interesting to hear this perspective. When you're thinking about strategic next steps in planning, how does something like blockchain technology and that sort of thing figure into your planning?
I'll be first to answer. You guys can. I think all of us are involved in multiple asset classes, multiple clearing frameworks, multiple accounting frameworks, multiple administrative frameworks, and it's all highly regulated. And so there are long-term legacy operations like DTCC, and so what we see specific to equities, but with a lot of awareness about everything from crude oil to carbon futures, is an awareness that the standard has been working, but just because it works doesn't mean it's the long-term solution. So I think there's kind of incremental and parallel change happening. As our earlier comment about the resiliency and steadfastness of U.S. capital markets during kind of highly volatile times, including clearing and settlement, it makes us kind of aware of how fragile change is. So we want to change with the times. We want to innovate. We want to lead from our pipes and sewers and how we operate, but we do that with incredible caution and vigilance. Now, on the flip side, from a capital markets point of view, bringing products to market, listing ETF solutions or working with companies that are deep in those spaces. It's actually, we've been operating like that for 5 years, and we learn from them, and hopefully they learn from us, and we innovate together.
Okay. Thank you. A quick question to all members of the panel. Any thoughts on the short-term and long-term impacts to core session liquidity due to 24/5 trading?
I'll jump in on that. So to Tim's point, we're already opening up at 4 a.m. today. And I think the extra hours, I mean, it's definitely more. It's more to ask from a market making standpoint. It's more to ask from an industry standpoint. But I think I'd almost like redirect that to the market making community. As the exchange side, we can constantly come up with different programs and models to incentivize liquidity. And we definitely do that during the core session. I think it's going to be really interesting to see how volumes increase once trading hours are expanded, and then kind of go from there to evaluate that impact.
You have a proxy with Blue Ocean, but they're. I apologize to anyone from Blue Ocean if this is not a compliment, but their spikes in activity are generally more in the kind of low price stocks and rather concentrated. Not always. There's news and there's times that that's not the case. But you can trade U.S. stocks on an ATS throughout the closed time, and I compliment their innovation and I compliment the client set that they're trying to address. But we haven't seen it drive meaningful change in trading in notable, significant, and durable, U.S. securities.
Agree with the other two panelists.
A quick question also about the 24/5 is what would happen to earnings announcements and M&A announcements, which are traditionally done before or after markets are open?
I'll go. All right. Sorry, I'm talking too much. Anyway, we're all exchanges, well, at least, and we list a lot of companies, and I think we should halt them until the primary open and let price discovery and such happen. But I'm not sure that's the most modern solution to the problem. But the reality is we do reg halts all the time, and we're very cooperative across exchange platforms and sharing that information in an elegant way and opening and closing stocks based on news and kind of other considerations. So I think that would kind of fit well into it. I think it's I think that continues, but there may be a shift for particularly global companies to think about that 8 p.m. to 9 p.m. Eastern time, when all markets are closed across U.S. equity markets, has a opportunity or window to announce news. But for now, cooperative consolidation around halts and messaging with the corporate and the exchanges is what I see happening.
All right, I think we had a question at the front.
Could you just expand on the remarks you made around market maker capacity, or being stressed as far as market makers capacity on? I mean, you mentioned like there's 11 to 12 market makers out there today. Is the problem that there should be 13 to 15 because there's a part of the market that is not being serviced, or is it that these 11 to 12 that they're doing it, they don't see the incentive to be making markets in more of these other issues, or there's some capital constraints around them? And then obviously, if you could tie in if Rule 5250 could address any of those problems.
Yeah, I mean, being a lead market maker, or as they're called on NASDAQ, a designated liquidity provider, can be a loss-leading business sometimes for these DLPs and LMMs. So, it's definitely really appreciated that they're willing to take on new ETFs and take on that risk of, will this ETF add to their business and be profitable when they're already managing hundreds of ETFs in terms of spreads and depth. And then also, the issuers will ask for, certain trades around rebalance times, or, RFQs, things like that. So, there's a capacity issue in terms of the number of firms that their business models are set up in such a way that they're able to have the balance sheet capacity to be a market maker, and then not only be a market maker, but also a lead market maker in terms of, working with these issuers to hopefully build a larger trading relationship and larger trading volumes, with these firms, which can be difficult, for certain issuers. So absolutely, it's an economics, it's a financial thing. In the beginning of the ETF industry, the banks that are now APs, the Goldman Sachs, the UBS, Morgan Stanleys, they were lead market makers as well, and they're not anymore because it's not as profitable for their businesses. So they're APs because you have to be a U.S. self-clearing broker-dealer in the U.S. to be an AP. But unlike in other parts of the world, you can't pay market makers directly in the U.S. So the exchanges, we have essentially subsidy programs through our market quality programs that help with that. But there is definitely more we could do as an industry, and with the explosion of ETFs, we're definitely at a tipping point where, as an industry, we're going to have to figure out how that looks in terms of the best solution, because simply just allowing issuers to then directly pay market makers comes with a lot of other questions. And again, that's not something that the exchanges allow or disallow. It's a FINRA rule, but there would be kind of methodology kind of questions for us to all answer. And what does that look like?
Yeah, thanks for your question, Jim. I think the 11 to 12 market makers out there today are absolutely tremendous. But just like additional exchanges are now entering the ETF space, I think additional market makers entering the ETF space drives overall competition, and competition drives innovation throughout the industry. And it also gives additional firms a chance to help the existing ETF ecosystem and contribute to those deep and liquid markets we're all trying to incentivize as exchanges today. So with the rise of multi-share class, with the rise of a record-breaking year for ETFs in general, I think the inclusion of additional market makers is welcomed by the industry as a whole. Just so ETF issuers have more options, they're able to develop and cultivate additional relationships and further build and advance their businesses. I know in the STA ETF committee, the topic comes up all the time around Rule 5250. To Danielle's point, in Europe, you could actually pay your market makers directly. In the US, you cannot do so. I think that's a question and a topic that has been raised by a lot of issuers. If we'll see the US advance to that point, there's a lot of differentiating viewpoints on that today, and we're still constantly continuing that dialogue with our clients. but it would definitely be an interesting trend in the United States if we were able to offer that on top of the exchange incentive programs that we have in place today, because we do truly appreciate the support that the market maker community provides the ETF ecosystem, because without them, spreads would be wide and investor fills would not be as great as they are today.
All right, I think we're coming up on time here, so I want to thank the panel for making my questions seem insightful. I want to thank ETF Global for having us, and everyone enjoy the rest of your day.